Hello and welcome to Business Standard Views of the Week. Did Budget 2022 go back to the government's protectionism agenda? Was it an election budget? How much can the Capex increase boost economic revival? And what about rural India? Subscribe to Business Standard and read this week's top opinion pieces to find out. Finance Minister Nirmala Sitharaman on February 1st presented her fourth budget for the Narendra Modi government. In the second pandemic budget, she sought to crowd in private investment through a public expenditure push. The capital expenditure allocation for FY23 was raised by 35% to Rs 7.5 trillion. The finance minister called this a budget not for a year but for the next 25 years. In his column in Business Standard, Ratin Roy countered this and said that this was not a budget that would support economic recovery, whether through supporting aggregate demand or through expansionary stimulus. On public finances, A.K. Bhattacharya wrote that the budget had stuck to the Modi government's tried and tested formula of following the predetermined glide path for fiscal consolidation. From 9.2% of GDP in 2020-2021, the fiscal deficit in 2021-2022 was to have declined to 6.8%. The revised estimate of the fiscal deficit for the current year was now placed at 6.9%. And for 2022 to 2023, the deficit would be brought down to 6.4%. This would still be about 2 percentage points away from the target of 4.5% of GDP to be achieved by FY26. But a reduction of this order over 3 years should not be a difficult task. On the budget overall, Bhattacharya wrote that it was strong on transparency and adhered to the government's political beliefs even as it took the risk of increased borrowing to finance higher capital expenditure. This budget has come too close to some of the very important state elections. Shekhar Gupta wrote that the finance minister presenting the budget on the eve of a major election would brace herself for the familiar question on whether this is an election budget. How did this budget answer that question? Well, this may not be an election budget for the immediate state elections in that sense, that it does not offer large yojanas or giveaway for the farmers, or even an increase in direct benefit transfers, tax breaks or relief payouts. But Gupta wrote, if you were to look beyond the immediate state elections and tilt the periscope to graze at a more distant horizon, one would get the sense of how the Modi government wants things to look by the summer of 2024 when the Lok Sabha elections would be held. The budget also made some important proposals on defense manufacturing and military modernization. So from a defense point of view, was this a better and bigger budget? Bigger, yes, but not better, wrote Ajay Shukla. The total government outlay of Rs 39.45 trillion, the Defence Ministry was allocated Rs 5.25 trillion or 13.31% of total government spending. But there was silence on the fact that even as Chinese troops continued squatting on territory that India called its own, this was the lowest allocation in percentage terms since the 1950s. Also, as a percentage of GDP, the defense allocation amounted to just 2.03%, threatening to fall below the 2% threshold, Shukla wrote. Another important announcement in the budget that drew a lot of attention was the levy of 30% tax on the transfer of virtual digital assets. The move, which will have an impact on cryptocurrencies, was read by many as the start of according some legitimacy to privatize digital currencies. Mukesh Bhutani wrote in his column that the finance minister had constructively unveiled the framework for taxing the crypto economy. The fine print and tax incidents aside, this move was laudable because it gave a formal shape and reflection of a conscious evolution of India's tax policy, unlike the knee-jerk reactions and overruling of judicial determination, which had often been the trait of tax policy evolution in the past. A key contention about this budget was also that it gave no additional relief to the common man through a tweak in income tax rates or slabs. Harsh Rungta wrote in his column that the budget addressed some more important aspects even if it gave no tax breaks. It was clear, he wrote, that the government wished to nudge people's retirement corpus towards the transparent NPS system. Now, state government employees would also be allowed to deduct the contribution made by the employer to 14% of salary. Another major change was limiting surcharge to 15% on long-term capital gains. It effectively reduces the capital gains tax rate on sale of high-value assets such as shares in unlisted securities or immovable properties. Overall, on the agriculture front, the union budget seems to have underplayed the need to ramp up the sector, according to a Business Standard editorial on the subject. The farm sector, despite sustained growth during the pandemic, has continued to show signs of distress. Most of the measures presented in the budget for this sector are virtually repacked versions of ongoing programs. No new initiative has been mooted to cut costs or boost profitability in the farming and its allied activities, barring duty reduction on imports for export-oriented shrimp farming.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.